There is an affliction that plagues the active mind, a subtle poison that seeps into the veins of even the most determined speculator. It is not born of fear, nor of overt greed in its most recognizable form. It is the disease of action. It is the constant nagging whisper that insists you must be doing something, that the ticker is ticking, the numbers are flashing, and somewhere a great fortune is being made while you sit idle. This compulsion to trade, to be in the market at all times, to prove your own activity, is one of an amateur's most reliable paths to financial ruin. They call it overtrading. I call it the erosion of the soul. You must understand the market does not care about your schedule. It is not a salaried job where you are compensated for the hours you put in. You can sit before the screen for 10 hours a day, executing 100 trades, and accomplish nothing but the enrichment of your broker and the depletion of your capital. Conversely, you can study the market for weeks, do nothing, and then, in a single well-timed operation, secure the profits of an entire year. The crowd does not understand this. The crowd believes that effort is measured in clicks, in transactions, in the flurry of activity. They mistake motion for progress. The professional speculator knows that the highest form of effort is often supreme, disciplined, and patient inaction. The psychology behind this flaw is rooted deep in human nature. It is impatience. We live in a world that promises instant results. You want information, it is at your fingertips. You want a product, it arrives the next day. This conditions the mind to expect immediate feedback, immediate gratification. The tape, however, operates on a geological timescale by comparison. The great moves, the ones that build fortunes, do not unfold in minutes or hours. They take days, weeks, and sometimes months to mature. The amateur cannot bear the waiting. The silence of a consolidating market is deafening to him. He must force a trade, he must create a P&L, even a negative one, just to feel involved. He is like a farmer who plants a seed and digs it up every hour to see if it has grown. He guarantees the failure of his own crop through his inability to let nature take its course. Then there is the ego. The ego tells you that you are smarter than the market, that you can outwit it, that you can scalp a few points here, a few points there, dancing between the raindrops. The ego convinces you that you must have an opinion on every fluctuation. When the market moves up a point, your ego demands you have a reason for it. When it falls, it demands you have a counter-theory. This need to be constantly engaged, to be a commentator on every minor wiggle, is what drives overtrading. A true speculator is humble before the tape. He understands he does not need an opinion most of the time. He needs only to recognize the 1 or 2 times a year when the tape is screaming an opportunity so loud that to ignore it would be a dereliction of his duty to his capital. For all the other days, his opinion is that he has no opinion, and his position is cash. This, to the amateur, is an admission of failure. To the professional, it is the hallmark of discipline. I remember a time after a particularly successful campaign in the cotton market. My capital was large, and my confidence was larger still. I felt as if I had deciphered the market's secret language, that I could hear its every whisper. I returned to the stock market looking for the next grand move, but the market had no grand move to offer. It was a period of dull, listless consolidation. The great leaders of the day, stocks like U.S. Steel, would trade in a narrow 2 or 3 point range for weeks on end. They would rally 1.5 points in the morning on some meaningless rumor, only to drift back down by the close. There was no trend. There was no story being told by the tape. The line of least resistance was perfectly horizontal, but I could not accept it. I was Jesse Livermore. I had to trade. My ego demanded it. So I began to scalp. I would watch U.S. Steel tick up 50 cents, and I would buy a substantial line hoping to sell it a point higher. Sometimes it worked. More often the small rally would fail, and I would sell for a 1/4 point loss, telling myself I was being prudent and cutting my losses short. Then I would see it drift to the bottom of its little range, and I would sell it short, hoping to cover a point lower. Again, the market would refuse to grant me even this small favor. It would drift sideways, forcing me to cover for a tiny profit or another small loss out of sheer boredom. Day after day, this continued. I was making dozens of trades. My mind was a blur of fractions and ticks. I was not speculating, I was gambling on meaningless oscillations. Each small loss was insignificant on its own. A quarter point here, a half point there. But they were like 1,000 tiny cuts. They were bleeding my capital, slowly but surely. More than the money, they were draining my mental and emotional reserves. When you are engaged in this constant frenetic activity, you lose perspective. You can no longer see the forest for the trees. Your mind, which should be clear and focused on identifying the next major opportunity, is instead cluttered with the post-mortems of 100 failed scalp attempts. You become irritable, reactive, and out of sync with the market's true rhythm. The great opportunity, when it finally arrived, found me unprepared. After weeks of this choppy action, the market finally made its mind up. The whole list began to move, signaling the start of a new, powerful upswing. But I was so mentally exhausted from the dog-fighting in the trenches that I almost missed it. My capital was slightly depleted, but worse, my confidence was shaken. I had been wrong so many times on my small trades that I hesitated to be right on the big one. I had squandered my most precious assets, patience and clarity, on a battle that was never meant to be fought. That lesson was burned into my mind. You do not get paid for the frequency of your trades. You get paid for the correctness of your few, well-chosen trades. The periods of waiting are not wasted time. That is the time you are being paid to observe, to study, to let your plan mature. Today, this disease of action is 1,000 times more potent. In my day, you had to go to a broker's office. There was a physical barrier to placing a trade. It required thought and effort. Now you have the market in your pocket, a glowing screen that beckons you with every flicker of green and red. The news is constant, the opinions are endless, the chatter from so-called experts never ceases. It is all designed to make you feel that if you are not participating right now, you are a fool. The very structure of the modern market encourages overtrading. Commissions are low or non-existent, but do not be deceived. Your cost is paid in other ways, in wide spreads, in poor execution, and most critically in the constant temptation to act without proper cause. Consider the chart of the S&P 500 over the past year. You will see magnificent sweeping trends that last for months. And you will also see periods of weeks, even months, where the index goes nowhere. It is trapped in a wide, volatile, but ultimately sideways range. The uninformed trader looks at this range and sees 1,000 opportunities. He buys at the bottom of the range, and as it moves toward the middle, he grows fearful and sells for a small profit. Then he watches it go to the top of the range without him, and he curses his impatience. He then decides to sell short at the top of the range. The market dips, but not as much as he expects. He covers for another negligible gain, or perhaps a small loss when it reverses abruptly. He is whipsawed back and forth. He is trading the noise. He is fighting the tape. His account statement at the end of this period shows dozens of trades, a flurry of activity, and a net result that is flat or negative after all costs are considered. He has worked very hard to lose money. The professional speculator looks at the very same chart and sees something different. He sees the range. He recognizes that the market has not yet decided on its next major direction. The buyers and sellers are in a temporary state of equilibrium. He understands that trying to trade within this range is a low-probability, high-stress endeavor. So, what does he do? He does the most difficult and most profitable thing of all. Nothing. He sits in cash. He waits. He watches the boundaries of that range. He knows the real opportunity will not be a trade from the bottom to the top of the range. The real opportunity will be when the market finally breaks out of that range, either to the upside or the downside, on a significant increase in volume. That is the signal. That is when the line of least resistance has been clearly established. That is when he will commit his capital in one decisive action to ride the next great wave. He makes one trade, while the amateur made 50. And his one trade will be more profitable than all of the amateur's frantic efforts combined. Let us construct a more specific scenario. Imagine a leading technology stock. After a strong run, it begins to consolidate. For a month, it trades between $150 and $160. The overtrader, the man of action, cannot resist. On Monday, he sees it tick up to $152. The breakout is starting, he thinks. He buys. By the afternoon, it has drifted back to $151. A false alarm, he concludes. He sells, taking a small loss and paying his broker. He is annoyed, but feels he has prudently managed his risk. On Tuesday, the stock dips to the bottom of the range, touching $150. This is it. The support is breaking. It's going down, he tells himself. He sells it short. The stock holds, then slowly grinds its way back to $151 by the close. He is now short in a market that refuses to fall. He holds overnight, a knot of anxiety in his stomach. On Wednesday, the stock opens at $152. His short position is now a loser. The fear of a larger loss grips him. He covers his short, taking another loss. He feels frustrated and outsmarted. Later that day, the stock rallies to $155. "I knew it was going up," he exclaims, forgetting that just yesterday he was convinced it was going down. The fear of missing out, the most powerful of all market emotions, takes hold. He buys the stock at $155, near the top of its range, chasing the move he feels he is entitled to. For the next week, the stock does nothing. It oscillates between $154 and $156. His position is profitable, but barely. He is bored. His capital is tied up in a stock that isn't moving. He sees another stock making a dynamic move and feels the pull of action. He sells his position at $155, breaking even before commissions. He has made at least 5 trades, experienced a roller coaster of hope, fear, and frustration, and has absolutely nothing to show for it. He is mentally and financially poorer. Now consider the patient speculator watching the same stock. He sees the chart and recognizes the $150–$160 range. He reads the tape and it tells him there is no institutional demand, no compelling story. The volume is light, the stock is sleeping. He does nothing. For a month he watches. He is not bored, he is observing. He is waiting for the market to signal its intent. His mind is clear. His capital is 100% intact. He feels no emotional attachment to the stock's daily wiggles. Then, one Tuesday, something changes. The stock opens at $158. It trades quietly for an hour, and then a surge of buying comes in. The volume on the tape is immense, far greater than anything seen in the preceding month. The stock breaks through the $160 resistance level with authority. It trades at $161, then $162. This is the signal he has been waiting for. The breakout is real, confirmed by volume. The line of least resistance is now clearly upward. He places his buy order. He buys a significant position at, say, $162. $50. He places his protective stop-loss order below the breakout point, perhaps at $158, managing his risk. He has made one trade. He entered not out of hope or boredom, but based on a clear, unequivocal market signal. He is now positioned to capture the majority of the next major upswing, the move that the overtrader, now exhausted and disillusioned, will likely miss entirely or chase at a much higher, more dangerous price. This is the difference between professional speculation and amateurish gambling. It is not about being constantly active. It is about being decisively active at the correct time. Trading is a game of calculated waiting. It is about preserving your capital and your emotional stability so that when the rare, high-probability opportunity presents itself, you're in a position to take full advantage of it. The market is a vast ocean, and its currents are not always strong. There are times of swift, clear tides. These are the trends you must ride. But there are also long periods of slack water, of confusing eddies and cross-currents. To try and navigate these with a flurry of activity is to risk capsizing your vessel. The wise mariner knows when to drop anchor and wait for the tide to turn. For a trader, sitting in cash is dropping anchor. It is a position of safety and of strength, allowing you to observe the weather of the market without being tossed about by its every whim. Do not mistake this for a call to inaction. It is a call to purposeful action. Your research, your study of charts, your reading of the tape, that is your work. The trading is merely the execution of the conclusions drawn from that work. If your work leads you to the conclusion that there is no clear opportunity, then the correct action is no action. If you find yourself making multiple trades a day in and out of the same stocks with little to show for it, stop. Step away from the screen. Ask yourself, am I trading based on a sound, well-defined plan, or am I trading because I am bored, impatient, or afraid of missing something? Am I following the market signals, or am I trying to impose my will upon it? The tape is always telling a story. Most of the time, that story is dull. It is a story of indecision and consolidation. The amateur tries to write his own exciting chapter in the middle of this boring narrative and fails. The master waits until the tape begins to tell a compelling story of trend and momentum, and only then does he pick up his pen and add his own line to it. The money in this game is not made from buying and selling. It is made from sitting in a winning trade, and just as importantly, sitting in cash while you wait for that winning trade to appear. Tame the impulse for constant action. Embrace the wisdom of patience. Your brokerage account and your peace of mind will be the ultimate reward.